What's up, everyone? It's Karthik with MoneyVest. Welcome on board for our Tuesday market open live stream. And we got to brace for impact as it is not looking great out there. Palantir is dropping. We've got Tesla also selling off. Nvidia is also lower pre-market. Everything is down at least 1.5 to 2% as the NASDAQ and S&P 500 is also selling off. We got QQQs down over 1.5%. We got S&P 500 down over 1% at the moment. Of course, we got Nvidia down over 2.3% and Palantir, of course, taking the brunt of that pain, down almost 8%, trading down to about $190 a share. And not to mention, crypto is seeing a lot of liquidation. We are trading at around $3,500 for Ethereum. And Bitcoin is really selling off now, trading under 104,000, down over 2.5% here. And support level is going to be closer to about $100,000 for Bitcoin. So yes, Bitcoin, Ether, selling off rather aggressively here at the moment. So hope you all are doing great. Welcome, everybody. Thank you so much for joining, and hope everybody is doing well. Happy Tuesday, and yeah, good bloody Tuesday is what we're seeing. What's happening in the market, and what's your predictions till Friday? So Diogo, welcome to the channel. We don't make predictions here, but we can tell you, based on risk reward ratios. I mean, you got volatility here. So VIX is up over 12.5%. And look, if you literally go back, you know what? I'm going to bring it up just so you guys know that I'm not making this thing up. I had specifically mentioned in my yesterday's market update, and also specifically talked about in the market update yesterday, the VIX is creeping up. The VIX is slowly and steadily moving higher. So you'll notice I mentioned VIX slowly creeping up here. And I think it's really important to hedge that downside. So far, we are up on the month of November because of the first day being very green. But be careful in this market, as I'm starting to sense some downside protection might be needed because of the state of the market, right? So VIX is creeping up with 3 green candles, and investors hedging portfolios for downside protection. 2 back-to-back updates with the same message. Why? Because we had already seen the liquidity flows as well as the volatility that was creeping up, right? So as a result, we're up about 19-20%. Or getting back up to over 19 right now, so up over 12.5% pre-market. So we're seeing a little bit of that momentum back higher. And we'll take a look at where MoneyVest Index is most likely going to be. But from the looks of it, it's going to be closer to 3.5, closer to those numbers. Right now, we're sitting around 3.5. 3.35 is where we are. We're in neutral, but it's going to be a good sign if we actually get closer to 3. So if we get down to low 3s, that is good. That's exactly what we want to see, because the lower this number gets down to, the better the risk reward is going to be. If there is one thing, only one thing that you take away from this channel, is once the MoneyVest Index is in fear or panic, I close my eyes and I hit the buy button. That's it. I'm not looking elsewhere. I'm not looking at the news flow. I'm not looking at geopolitics. I'm not looking at what's going on with the trade war, with inflation, with the Federal Reserve. None of that matters to me. If the MoneyVest Index comes down to below 2.5, even if it drops below 3, we are already in uncertainty, but preferably below 2.5, closer to 2, closing my eyes, hitting the buy button. Closing my eyes, hitting the buy button. That's what I will be doing if the MoneyVest Index, of course, comes down. Right now, we're at 3.34, 3.35 for the S&P 500. And NASDAQ right now is a little bit higher because of this concentrated rally. We're still in optimistic, but this number is most likely going to drop below 3.5 at market open. So we'll take a look at it together as soon as market opens in about an hour. We'll take a look at where the S&P 500 and the NASDAQ 100's MoneyVest Index is currently trading. And pre-market, I can already sense that it's going to be closer to 3.25. To 3.2, and the NASDAQ 100 is most likely going to be below 3.5. We're going to be neutral for the NASDAQ 100. So again, good morning, everybody. Thank you so much for joining. HIMS stock is popping higher. So, for a change, we are seeing HIMS pre-market up over 3% right now, so a little bit over 3%. Still nothing crazy. I mean, it has sold off a little bit pre-market. So if you come over to HIMS here, you'll notice that we were higher, trading up to $46, $47. Then we sold off about 5.6%. Now we're starting to recover back up a little bit. But pre-market, of course, there's a lot of red out there. So if you come over to this watch list, and we're gonna put up the pre-market hours, we're gonna sort this by stocks that are going down the most and to the least. Palantir at the top of that list is down over 8% now. It is actually sitting below 190. So this is going to be Palantir right there. I did a full earnings video, so make sure that you do check that out. I think valuation at the end of the day will also really matter for investors at some point, because even though the numbers were phenomenal, right when the earnings came out, we saw Palantir jump to 222. So that was a new all-time high, of course, after hours, about a 6.8, almost a 7% increase. And then the real move started. It dropped about 7.5% in a matter of just a few minutes. And that sell-off has continued. And from its after-hours high to its pre-market lows, it is down almost 15% from yesterday's after-hours spike to today's pre-market lows. That is a pretty substantial drop here. So coming back to the 5-minute chart, hitting a new low of the day, sitting at under 190, down over 8% at the moment. So that's Palantir for you. Grab is down over 7.4% as well. We got Oklo down 7%. We got Nebius down almost 6%. AST Space is down almost 6%. Rigetti Computing, we got BITX down almost 5% on the back of Bitcoin. We got TQQQ, of course, the leveraged ones. Iron is down over 4.7%. And it's a good thing. I didn't have to roll my option on Iron. We were really contemplating yesterday. I don't know if Tempelhof is watching right now, but he and I have the same call for this Friday, and we were really contemplating, do I really need to roll this? Because we did get up to over $79, almost $78. I don't know, Dave, if you have the same call or if you're trading Iron, but we were like right there. We were like, okay, time to roll. It's a $70 call. But then within minutes, it dropped down to like 65, 12.3, 12.4% drop for Iron. It did get a little bit of a price upgrade to 120, 125, which I think is ridiculous for a company, 100% growth from here. But yes, we got a nice little pullback, and those calls are now printing. And that's exactly what's going to happen today. A lot of us who've actually sold calls are going to be printing today because all those calls are going to be essentially hedges against our long positions. And that's why it is so lucrative to have a plan in place in order to hedge your positions. You can always consider selling calls. And of course, when you do see these pullbacks, do see these corrections, those calls go up and we collect that premium, which we can reinvest back into buying the dip, right? Buying the actual sell-off. And so you can continue to generate more income and reinvest that premium back into your longer term positions. So Iron, nice little pullback here, 4.7%. And coming back over to this watch list, Robinhood is down 4.3%. Open Door down over 4%. SoFi down 4%. SoFi has really been fluctuating a lot, right? I mean, it's been around the $29 to $30 range, 30, 31, 32 for quite some time. So after a very strong rally from literally from 9s and 10s, it has, of course, tripled in value, 275, 300% gain for SoFi, and now it's essentially trading sideways. We're seeing a little bit of that resistance at $30 to $32, and a very strong support down here at $24, $25. I mean, I could see myself adding a little bit at $24, $25. I could see myself selling puts in and around those levels, but resistance for SoFi is going to be at $30 to $32 for this company right now. Oscar down over 3%, trading back down to $17. So really, really selling off here. And of course, breaking below this area of support of $17.40. And unfortunately, and I hate to say it, but there's going to be some deeper support levels to watch for a lot of these companies, right? I mean, for example, Palantir. If it breaks below 189 right now, pre-market, it's trading around 189, 190. That is a previous resistance, and that's exactly where we have this area of demand and that support. As unfortunate as it is, and again, this is purely technical, if we do break down this support, the next one is at 173, right? So it's going to be about 10 to 12%, about 8%, 9% away from where the current support is. Same thing is true for say BITX, if you break down below this, which we already are, pre-market, it's not looking good on the back of Bitcoin. Then the next support is going to be all the way down at $39, right? 39, and then we're looking at around 33, 32. Same thing is true for BMNR. BMNR pre-market absolutely getting destroyed down in the low 40s now. So this was the next support for BMNR right there, which is $39 to $40. And looks like we're almost getting down to that price point, all thanks to Ether and Bitcoin, which obviously are selling off very aggressively pre-market. So so that's where we are. I'll take a look at some more companies here. Scoop says VIX up, we buy. Correct. That is a very simple playbook. It's a very systematic approach to investing and understanding market dynamics. There's nothing more to it, and we like to keep it very simple. We're simple folk here, right? We don't like to overcomplicate it. This index and a lot of the quantitative analysis, a lot of statistics is complicated enough. So we like to keep things very simple, with a simple gauge, a simple index, a simple number to follow. And if the opportunity presents itself, when we see red, we are excited, we're ready to deploy. And, we've done it many times over and over again. I know that a lot of investors, especially ones who are getting started or who are new to the market, might get a little bit turned off with a lot of red, with a lot of selling pressure. Seems like it's not working out. But this is the cycle. This is literally a cycle. We've been here before. We've done this before. And something that you have to condition your mind over many, many years. And you have no idea. Like, I speak to so many investors after so many years, and they're like, I finally got it. I finally understand that red is good, right? Red is good. Deals and discounts are great for investors long term, because that's when we get the best opportunities. That's when the risk reward gets a lot better. And risk reward quite literally depends on the price. If the price is coming down, risk is coming down with it. If the price keeps going up, risk is also going up, right? That's what we have to analyze at all times, is the risk and reward. And once you really start to condition this and really just hone in on this, it becomes so much easier. It becomes more clear, it becomes easier. You start to look at the bigger picture. You're like, okay, if stocks are selling off, that's always good news. And I can always dollar cost average, and I can be a lot more strategic about my investments. So Thomas, Caddy, I'll be honest with you. I don't know anything about calls and puts. The only hedge I know is to sit on cash in my portfolio and deploy it when the VIX spikes to 30 plus. That's basically my strategy. And it's one of the best strategies out there. Quite literally. I tell people all the time, like, if you simply follow, some basic stats, which is volatility. Of course, you can layer in the MoneyVest index as well, because it's a combination of a lot of indexes and indicators that we track, because it's not just tracking volatility. This also tracks market breadth. It also tracks market momentum, and it also tracks what I consider to be a very, very important metric, which is the market threshold. And market threshold, which we are going to put on the MoneyVest platform eventually, is simply showing you how much are we down from all-time highs. That's it. That's quite literally a very simple metric. It's showing you how much are we down from all-time highs. And in my previous updates, if I bring up the spreadsheet, which we are eventually going to have it on the MoneyVest platform, this is it. This is the spreadsheet, and this is what's showing you whether we are down 0 to 5% from all-time highs, which is considered a dip. Are we in a pullback, 5 to 10%? Are we in a correction, 10 to 20%? Are we in a bear market, or are we in a full-blown crash? Why? Because I've also got a spreadsheet that tells us in the last 200 plus years how many times we've actually been down more than a certain number. So this is the bell curve. This shows you exactly what year and the return for that year in this market. Obviously, you see a lot more green than red, and that simply means the markets have actually gone up more years than they have gone down, historically speaking. 72% of the years have been green for the S&P 500, only 28% have been red. And if you really, really just look at this bell curve, over 20 to 30% down, that's even lower. That's even less, right? So we're talking about, what does that count? 12, 4, 16, and 2, 18. 18 years out of 200, right? That probability is about 9%. 9% of the years of the last 200 years, the markets were down over 20% in a single year, okay? So 91% of the times markets were down, or obviously green, or if they were down less than 20%. If you were to consider 10 to 20% also, so we can just add 18 plus 36, so whatever that number is, 54, so we're going to do 54 divided by 200. So we're now looking at 27%. So as I said, we are very statistically always pays to be bullish and to actually be a net buyer of stocks over the long term. Now, of course, I don't want to oversimplify things because there's a lot of other things that also do matter for the markets, especially what we have seen is U.S. dominance and U.S. leadership over the course of many years on the back of technology, on the back of these big tech, Magnificent Seven companies. They're getting a lot of liquidity from the rest of the world, a lot of foreign investors, a lot of foreign banks investing in these companies. And as a result, they have become so big. But all of that is on the back of leadership, dominance, earnings growth, and just a pro-growth culture, right? Capitalism in the U.S. If that wasn't existing, then of course we would be talking about a different country in a different market. So, of course, like I said, not to oversimplify things, but I like to look at volatility, money vs index to keep things super simple and just continue to dollar cost average when the opportunity presents itself. How low do you think Palantir will go today? Well, Doria, so I think 190 is already a pretty strong support. If 190 holds today, then I think that's going to be a pretty strong area of demand. It's possible that we do see a gap down and a green candle. So, a lot of the times it's very possible that we see a gap up and then a red candle and then we see a gap down and a green candle. So I see it all the time where we would see a green day but a red candle and a red day but a green candle. That simply means that on the day, the stock was down relative to the previous day, but intraday, we had the buyers stepping in. So it gives you two very distinct data points, right? Because you can't just look at, Palantir stock is down 4% today. Sure, it tells you, okay, relative to yesterday, it's down 4%, but what happened intraday? Was it a green candle? How big was that candle? What was the low? What was the high? What was the low? What was the close? And that tells you, okay, intraday, there was actual buyers stepping in, scooping up shares at those prices. Did we cover the entire gap or did we cover half of it? A lot of that is context, right? It's a little bit of a nuance. So 190 is going to be that support. If that level gets validated, great. If you see buyers stepping in. If you do see a breakdown below 189 on the day, I think we could be headed down to 173. Same thing for Meta. Meta sold off, pretty huge gap up, failed to recover on that gap, failed to recover over 680, and the last 2 days have been even more brutal for Meta. So, 3 days consistently selling off. Even yesterday, we saw a little bit of a gap up, but then eventually we sold off that entire move, and pre-market we're down another 1.2%. So 630, I may add a little bit of shares today, but really anything closer to 590 would be even better because we're now less than 7% away from my light buy on Meta. Meta's light buy is around 590, and considering that it's down at 630 right now, we are less than 6%, just a little bit over 6% away from my light buy on Meta. So that's my honest answer. Obviously, nobody knows, but yeah, that's what I expect from Palantir. HIMS stock we already covered. Again, it's coming up to that resistance here. Is that how the British say good morning? Yeah, I think I kind of read it in a British accent as well, because I know they do say bloody quite a bit. Let's take a look at EOSE here. Good morning, Karte. Good morning, everybody. Cold Floridian on the roller coaster. Then British. We already covered Thomas's comment there. Buy targets for Amazon and Meta. So we already have buy targets on our platform. Like you can pretty much refer to that. But like I said, Meta 590 is my light buy for Meta, and Amazon. I'll take a look at it in just a minute here. Support level for AMD we can also look at, and starting position in SanDisk. So let's just quickly go over to EOSE. And then let's take a look. Looks like we've done some analysis on this. I would put down another support down here at 1330s. And it seems to be forming a little bit of a bull flag. If the volume picks up, this could be a potential contender for a breakout because of the massive move here and a lot of consolidation, and then another breakout getting up to $21, $22. But the volume has to really pick up. I mean, the volume has really been sliding down for this company. So keep a close eye on volume if it picks up. And if you do get a breakout, then a retest, and then a continuation up to $21 with a support at 1330. Looking at SanDisk, wow. I mean, we analyzed this stock earlier last month, and it's been on an absolute crazy rally here on a weekly basis. You can see how overbought this is. So I'd be extremely careful with this stock, right? Because there seems to be no support level. No valid support that I could identify. All I can say is that it is on a very consistent uptrend. You can see on the daily, seems to be getting bought up here, higher highs, higher lows, very, very overbought. And so I would keep a close eye at 165 as a reasonable support for SanDisk. Of course, has the potential to break down further, down to 111, 112, some more levels to watch, given how overbought and overextended the stock is right now. Okay, let's come back to the chat. Yeah, Roblox and Amazon. So let's just go over to Amazon for Naresh very quickly. Actually, Roblox very quickly here. We'll come back to Amazon. So selling off 3 weeks in a row, consistently pulling back. I believe there was somebody talking about Roblox in our community. I forgot who it is. I think it was somebody we were talking about Roblox as a stock and also as a potential product, because I believe their kids are using or playing on Roblox or something. But support level is going to stay at 99, close to $100. That's going to be the level. And again, it's starting to roll over quite aggressively. And it was consolidating sideways. We got a resistance up to 141, 112. And so I would watch $99, anything under $100 as a potential area to watch for Roblox. On our Discord, I mentioned on red days, we plant seeds, we nibble on our long-term positions, we can look for swing trades, and we sell cash-secured puts. Absolutely, 100%. I think that's the time to be aggressive. That's the time to really, do your homework during green days and deploy during red days. Do your homework, do your analysis and research during good times, and take advantage during bad times. That's really what it comes down to, because buy windows are smaller. They're not there for super long, especially in this buy the dip market, in this environment where there is a lot of momentum. You don't get the opportunity for very long. So the people who are doing their research analysis, who've done their homework, who have a game plan, will be better off than people who are just not doing their homework. So that's why, in our community, in our Discord, that's what our focus is, like doing the research, doing the analysis, and being prepared. I was kind of searching my videos by titles, and if I look the word prepared and ready, they are the ones who come up the most, right? Because that's the conditioning that I do for myself, and then I also want for my audience to always be ready, be prepared for those deals. So that's what it is. Okay, coming back to some of the comments here. Starting position on SanDisk, we already covered. Amazon, we'll take a look at quickly. I'm going to move the chat over here, because we do have a lot of spreadsheets. One more thing I want to show you is the market timing game, and that was kind of like the motivation behind me building my spreadsheet. So right here, if you go to engaging data, I hope it's going to open up because it hasn't worked in the past sometimes, but let me see if it opens up. Okay, right here. Yeah, so should you invest or wait when the stock market is at an all-time high, right? Or wait when the stock, yeah. So should you buy or wait, when the stock market is at an all-time high? So this is a good sort of a study, but this is only going back as far as 70 plus years. And this was kind of the motivation that I wanted to have to build my own spreadsheet and do the data analysis. But what this essentially shows you is this chart, which was the intriguing part. And it shows you exactly what's the percentage of times the stock market is within a certain threshold, right? So within 1% of all-time highs over the last 70 plus years, that's 21%. So that simply means that 1/5 of the time over the last 70 years, the S&P 500 is spent within 1% of all-time highs. So that's practically all-time highs, right? So that simply means that, okay, over the last 70 years, 21% of the times, or 4,033 days, the market is at all-time highs. If you look at within 5%, then that is 27% of the times, right? Within 5% of all-time highs. Just going to quickly add up these numbers just to make sure that we are correct here. So 100%. Okay, perfect. Now, within 10%, you've got another 16%, and then within 20%, you have 20%. So when you add up all these numbers, we're talking about 84% of the times we are within 20% of all-time highs over the last 70 years. So that's why I was talking about those thresholds that, okay, if the market is down more than 10%, already hitting a pretty rare reading on these indicators. If you're down over 20%, which we were back in April, S&P 500 was down over 20% at one point. So this right here was the entire sell-off, which a lot of people forget that this was a bear market for the S&P 500 briefly. At one point, we were down over 21%. So this right here, the 20% sell-off, already put us into a very, very rare market situation because we had already seen this about 18%, 16% of the times, right? Whatever that number ends up being, 16% of the times. So that was a clear buy indicator. It was like, okay, you need to be deploying capital. You need to be putting money to work because of the rarity of that situation. Now, can it be longer lasting? Of course. Can it last a little bit longer, a few months, few years even? Yes, the bear market can last much longer. And it has in the past. You can see 2001, 2002, after the great dot-com bubble bursting. This was a great financial crisis. I mean, this was really just a whole decade where the S&P 500 really just was trading sideways. Of course, it did give us a lot of volatility, but that's the whole point, right? A lot of people would also kind of assume that we are sitting idle during that entire period. So S&P 500, if you come back to that lost decade where we didn't really go anywhere between 2000 and 2009, essentially. We didn't hit a new all-time high until 2013, actually. So about 12, 13 years, the S&P 500 was basically flat. But that is if you consider it at the very top of the dot-com bubble and the new all-time high of 2013. But if you are dollar cost averaging along the way, if you are buying more stocks along the way, our cost base is going to be much lower, right? It's not going to be up here. Maybe it's going to be down somewhere here for dollar cost averaging a little bit. So we're already in the green on the way back up as the markets are recovering. So that is another thing to keep in mind. But a lot of these stats help you make decisions better without overthinking it, because a lot of that really helps over the long term. Okay. Thomas, I seem to be doing pretty well. There have been many times that I should have been more aggressive in deploying, but all in all, over the past 5 years, the strategy has worked well. Yes, the strategy works. That's why we did the back testing, and the results are jaw-dropping. Uber selling hard. We'll take a look at that as well. Also looking at stocks to sell CSPs on stocks I want to acquire. Yes, absolutely. I'm enjoying the pullback because I don't want to roll my covered calls in SPY and QQQs again. I know, me too. Those covered calls are finally going to be out of the money and we can enjoy some premiums. Love the 200-year S&P performance graph. Very encouraging. Yep. So I highly encourage everyone to kind of check out those data points because it's going to build more confidence. And really, it's a quantitative approach to investing and trading because we're letting data really decide for us. Oh, yes. Templehoff was talking about Roblox because of Green Mike. Yes. Look at XLS. They reported earnings today pre-market. Could you look at their earnings and share thoughts here? Perfect. Bloom Energy. SoFi we covered earlier. Uber we'll take a look at right now, and Netflix as well. Okay. Uber Technologies down to $92, down about 7%. I mean, pre-market, I feel like a lot of stocks are selling off. Looks like a very strong beat on earnings and revenue from Uber. And $91, $92 is going to be that support level to watch for Uber. Resistance is going to be closer to $101, $102. So that right there is going to be that level to watch with a support at 91, all the way down to as low as $82, $83 for Uber. XLS Technologies pushing higher pre-market, so that's good to see, 6.6% higher. And I would say a very strong support at $77, $78. It has been consolidating sideways, so it was struggling to break out above this resistance. And so I would put down another support right about there at $85 for XLS. In terms of earnings, it looks like we got a nice little beat, 21% beat here with $1.21 in EPS, $213 million of revenue. I think this is still a company that has a pretty cheap valuation. We're looking at only 16 times earnings, a little under 3 times sales. But I think I mentioned this, the contraction in earnings in 2025 is resulting in the poor performance in the stock, and the acceleration will begin in 2026, 2027. 2027 really is when the growth starts to restart for XLS. So year to date, still doing relatively okay, 15% higher, but of course still off from its all-time highs quite a bit. From 200, it's down about 50% or so. So that's where we are. Grab is selling off, so definitely pulling back here. I think it's time to talk about Oracle's valuation and future forecast. Can you please provide your thoughts on it? Thank you. So Oracle had a huge gap up during September on earnings. Earnings and, of course, announcements with OpenAI. It's been on this downtrend ever since, lower highs and lower lows, selling off another 3%. I think 218 is going to be a decent support level to watch for Oracle. 218 is going to be that level. And in terms of valuation, we're looking at over 60 times earnings and a little bit under 13 times sales. So, yes, that is aggressive. Even if we're looking at $8 in earnings per share for next year, if you do the math, 250 divided by 8, we're looking at around 30 times earnings, which I guess is not terrible. But I do think that 218 is going to make the valuation look a lot better at closer to 27. That's going to be about a 10% reduction in valuation. And price to sales is going to be, market cap right now 735. Revenues for next year about 83 billion. So we're looking at 735 divided by 83, so about 8.8, just under 9 times sales for this company. So I think valuation at around 218 is going to start to look pretty good. Are the earnings going to grow 30% next year? Probably not, because we're going to be going from $8. We're going to be going from, actually, it might, 683. So divided by 683, we're looking at around 17%. No, half of that. So the PEG ratio is going to be closer to 2. So even at 218 on a growth adjusted basis, you could argue that it's still pretty expensive. But for software companies, they always trade at a bit of a premium. So 218 would be a good starting point. And then, scaling down to under $200 would be my, analysis on Oracle's valuation. So Palantir, we already covered at quite detail, did a video on Palantir, so make sure that you do check that out. We're looking at pretty expensive valuations for Palantir right now on a 2025 basis after pricing in the guidance. And even for next year, I think the guidance is strong, 2026 EPS of almost $1. But then again, you're looking at a stock that's trading at 190. So it's 190 times earnings for the company, right? So 190 divided by about 94 cents, that's 202 times earnings. Even if we assume that, okay, 94 cents is what they're guiding for now, or at least what the market is expecting. Let's say that Palantir continues to blow the numbers out of the quarter. It's not going to be 94 cents. Even in your wildest dreams, let's say that that number is going to be closer to $2. 100% uplift on the actual numbers. So 190 divided by $2, and we're still at 95 times earnings for the stock. But then the growth rate does justify that level of earnings premium for Palantir. So, in the past, what's really been the track record is earnings have gotten an upside revision, right? Analysts have continued to revise earnings to the upside, and Palantir has come out with some very strong beats. Especially over the last 3 to 4 quarters, they've come out with some pretty good beats here. So is 190 a good valuation for Palantir? Probably on the expensive side, most definitely. So 170, 160s starts to make more sense, even if you're considering, let's say, a 50% upside revision next year. So $1.50. So 173 divided by $1.50, and now we're looking at around 115, and then down to 160 divided by $1.50. We're looking at about 106. But the growth rate is also pretty strong in terms of the year-over-year numbers. So, Raul, can you explain a little more on why Palantir sold off after hours, even though they are outperformed? Head scratcher. That's the beauty of the market. That is what the market is all about. I've said this many times before, that even if you do give us the newspaper for tomorrow, you still can't really understand how the markets are going to trade. Even if you could have every, I shouldn't say every, but even if you had a pretty good idea on what interest rates or inflation and earnings are going to look like, let's say a year from now, it's still really difficult to predict where the markets are going to be a year from now, because how everybody dissects the data is, or potentially going to be very different than how you dissect the data. And that's why, we can have the best quarter earnings, we can have strong growth, we can have a guidance revision to the upside, and the stocks can still drop. And on the contrary, the company can come out with absolute abysmal earnings, no revenue, massive losses, and no business, and the stock can pop 20%. You know, that also happens. Why? Because it was less bad than what everybody was expecting. If you were expecting the earnings to be completely horrible and they were just bad, that is also positive. Believe it or not, that can also be positive for a stock. Less bad is also good for Wall Street. So it's crazy. You know, it's all about perspective. It's not about absolute. It's about perspective. And that's why growth companies can be head scratchers. You know, I've seen the story with Upstart. You know, believe it. It's a crazy story, but it is a story. Upstart was one of those companies growing at a whopping 700, 800%, 900%. Insane growth rate. And then what happened? Numbers got bigger and bigger. Growth rates got smaller and smaller. And even on an absolute basis, the company was growing. But since the growth rate was slowing down, the stock got absolutely crushed by Wall Street. And there was a quarter I remember back in 2023, I think it might have been this quarter right here, where we had a double beat, as you can see. 15% beat on earnings, great beat on revenue. And revenue actually grew. It might have been like over 70, 80% year over year. Stock was down 56%. 56, got cut in half because of the substantial drop in the revenue growth. Even if there was growth, it was a big drop. Okay, so let's take a look at Advanced Micro Devices, AMD. Very, very important company. Reporting earnings today. So after the bell, we've got earnings for AMD, about $1.17 in earnings, revenue of just shy of $9 billion. Support level is going to stay at $239, $240, all the way down to $200 for AMD. And it's going to be quite interesting if we once again get a strong beat on earnings, strong beat on revenue, strong guidance, and the stock drops down. $200, like I said, is going to be that support. But I don't think that we're going to have a volatility that big. If you come over to AMD here. So for today, the range or the expected move is going to be, that's going to be today. That's November 7th, November 3rd, November 4th. We're talking really just about 279 and 239. About 7.6% for this Friday's expiration moves. So that's where we are. So market's about to open in about 20 minutes here. And I'm going to try to get to as many questions as possible. Market breadth has been bad. Yeah, I mean, if you look at the percentage of stocks that are actually trading above their moving averages, it's not that great. And there is also a big divergence between stocks of S&P 500 and stocks of NASDAQ. So especially if you take a look at this, percentage of stocks trading above their 50-day moving average and even the 20-day moving average, S&P is only a third of the market. That's it. You know, majority of stocks, we're talking 67, 65% of stocks trading below their 20-day and 50-day moving average. 50 trading days. That's about 2.5 months. 20 days is going to be about a month, right? So 2/3 of the market of the S&P 500 is actually trading below their 2.5 month average prices. That just literally speaks volumes to how concentrated this market is. And if I bring you the NASDAQ stocks, NASDAQ 100 stocks, or let's just go over to NASDAQ Composite, trading above their 20-day moving average, it's at 44%. NASDAQ stocks trading above their, we just went over 20, let's go over to 50, and that is at 43, 44%. So better than the S&P 500. And I'm sure NASDAQ 100 is actually going to be even more. So NASDAQ 100 stocks, let's go over to 50, 54, more than half, right? And let's say NASDAQ 100 stocks trading above their 20-day moving average, 49. So half of the stocks are trading above their moving averages, 20 and 50 on the NASDAQ 100. So Milo says, looks like this month is going to be game over. Well, we are on a pretty strong win streak. I mean, if you really consider where we are on the SPY seasonality, this has been 6 months of pure gains for the market. So it would make sense why November may want to cool off a bit. But going back, how many years? We're going back 25 years. 1, 2, 3, 4, 5, 6. In the last 24 years, only 6 Novembers have been red. Okay? So literally since the turn of the century, only 6 Novembers have been red. So that is about a 25% probability if you were to put this in probabilities. Last November that was red was in 2021. Also a phenomenal year for the market, I will tell you that much. Because we had a 7-month streak between February and August, right? So consistent 7 months, and they were up like 2, 3, 4, 5%. May was slightly up 0.5%, but every single month was like bang on, strong gains. September down 4.7 as usual. September is a pretty bad month, and then 7% October recovery, and then November was slightly down. But then 2021, and then all the way back to 2011 is what we have to go back to find a red November, 0.5% down, and then 2010, 23 basis points down. So it's really been a lot less down, like a very muted month on the times that it is red, except for 2008, 7.5%, and 2000, 8%. So it's really during the great financial crisis and the dot-com bubble that November was absolutely brutal, down over 8% each. But other than that, it's held up really well. It's either green or it's down very, very small amount, like 0.5% or so. So high hopes for November. We'll see what happens, but high hopes for November for sure. How many people actually think November is going to be red? I want to do a quick poll. Month of November, green, down 0 to down between 0 and negative 1%. And then we'll do down more than 1%. Let's do this. Let's do this very quick poll because I'm really interested to find out what is everybody expecting for this month of November. So definitely participate in the poll that we have going on right now. Companies are bearing the earnings, so no red November yet, boys. Let's see. We'll find out. Maybe things take a turn over the course of the month. But who knows? It could be the best month. It could be a terrible month. Or it could be a normal nothing burger month. But anyway, coming over to gold, we are essentially trading sideways now. After the big sell-off, it's now under $4,000 per ounce. Really trading sideways. We got a huge area of support here. Seems to be getting validated a couple times already, around $3,900 to $4,000, and a huge resistance up to as much as $4,000 for gold. So again, a lot of consolidation sideways in that range. And I think silver is also experiencing some consolidation here. Of course, it was selling off aggressively, coming back down to $47.50, $47 support there. Another support is going to be down to $45, $46 for silver. So 51% people expecting November to be green. 38%. We've got some contrarians in the room. We've got some people who like to go against the crowd. Expecting 38%. 38% of people expecting November to be down more than 1%. So AI bubble could be the start. Yeah, I don't know if I buy the bubble analysis, but I do think that yes, valuations are high for sure. Are we going to see? You know what could be a very good opportunity is if based on this bubble thesis, a lot of really good companies drop more than what their valuation allows for. So back when the dot-com bubble happened, of course, there was a lot of internet companies with little to no revenues. These are pure ideas, and they crashed 70, 80, 90%. And the companies that were executing, that were the ones that were with revenue, with good cash flows, eventually recovered, and they were up like thousands of percents right since then. If there is any kind of bubble in the AI space and it starts to really bring a lot of these valuations down, I mean, if Nvidia is offered to us again at $80, $90, or Palantir is offered to us in the double digits, or any of these AI companies like Tesla, even Iron, then yeah, people are going to just scoop up so many of them. Yeah, all hyperscalers told they have increased capex for next year. You know what's interesting is I really want you guys to watch the... I think we should watch it together. You know what I'll do? I'll just pull it up and we'll watch it for like maybe 10 minutes or so, because I really want to play it while we're watching it, while we're listening in, and while we're talking about this. Is going to be the Sam Altman, Satya Nadella podcast. And they're talking about the compute, right? They're talking about compute. They're talking about...
level per year. Your process in place for this is a good thing to do. I expect...
Let's keep busting through the deal. So models and exclusivity. Sam, OpenAI... It's leading models on Azure, but I don't think you can distribute them on any other leading the big clouds for 7 years until 2032. But that would end earlier if AGI is verified. We can come back to that. But you can distribute your open source models, Sora, agents, codecs, wearables, everything else on other platforms. So Sam, I assume this means no ChatGPT or GPT-6 on Amazon or Google.
No, so we have a cat. First of all, we want to do lots of things together to help, create value for Microsoft. We want them to do lots of things to create value for us. And there are many, many things that'll happen in that category. We are keeping what Satya termed once, and I think it's a great phrase, of stateless APIs on Azure exclusively through 2030, and everything else we're gonna, distribute elsewhere. And that's obviously in Microsoft's interest too. So we'll put lots of products, lots of places, and then this thing we'll do on Azure, and people can get it there or via us, and I think that's great.
And then the rev share, there's still a rev share that gets paid by OpenAI to Microsoft on all your revenues that also runs until 2032 or until AGI is verified. So let's just assume, for the sake of argument, I know this is pedestrian, but it's important, that the rev share is 15%. So that would mean if you had 20 billion in revenue, that you're paying 3 billion to Microsoft, and that counts as revenue to Azure. Satya, does that sound about right?
Yeah, we have a rev share, and I think as you characterized it, is either going to AGI or till the end of the term. And I actually don't know exactly where we count it, quite honestly, whether it goes into Azure or somewhere else. That's a good question. It's a good question for Amy.
Given that both exclusivity and the rev share end early in the case AGI is verified, it seems to make AGI a pretty big deal. And as I understand it, if OpenAI claimed AGI, it sounds like it goes to an expert panel, and you guys basically select a jury who's got to make a relatively quick decision whether or not AGI has been reached. Satya, you said on yesterday's earnings call that nobody's even close to getting to AGI, and you don't expect it to happen anytime soon. You talked about this spiky and jagged intelligence. Sam, I've heard you perhaps sound a little bit more bullish on, when we might get to AGI. So I guess the question is to you both, do you worry that over the next 2 or 3 years, we're going to end up having to call in the jury to effectively make a call on whether or not we've hit AGI?
I realize you've got to try to make some drama between us here. I think putting a process in place for this is a good thing to do. I expect that the technology will take several surprising twists and turns, and we will continue to be good partners to each other and figure out what makes sense.
That's well said. I think, and that's one of the reasons why I think this process we put in place is a good one. And at the end of the day, I'm a big believer in the fact that intelligence capability-wise is going to continue to improve. And our real goal, quite frankly, is that, which is how do you put that in the hands of people and organizations so that they can get the maximum benefits? And that was the original mission of OpenAI that attracted me to OpenAI and Sam and team. And that's kind of what we plan to continue on.
Brad, to say the obvious, if we had super intelligence tomorrow, we would still want Microsoft's help getting this product out into people's hands, and we want them yeah.
Of course. Yeah, no, again, I'm asking the questions I know that are on people's minds, and that makes a ton of sense to me. Obviously, Microsoft is one of the largest distribution platforms in the world. You guys have been great partners for a long time, but I think it dispels some of the myths that are out there. But let's shift gears a little bit. Obviously, OpenAI is one of the fastest growing companies in history. Satya, you said on the pod a year ago, this pod, that every new phase shift creates a new Google. And the Google of this phase shift is already known, and it's OpenAI. And none of this would have been possible had you guys not made these huge bets. With all that said, OpenAI's revenues are still a reported $13 billion in 2025. And Sam, on your live stream this week, you talked about this massive commitment to compute, right? 1.4 trillion over the next 4 or 5 years with, big commitments, 500 million to NVIDIA, 300 million to AMD and Oracle, 250 billion to Azure. So I think the single biggest question I've heard all week and hanging over the market is how can a company with 13 billion in revenues make 1.4 trillion of spend commitments? And you've heard the criticism,
First
Sam.
of all, we're doing well more revenue than that. Second of all, Brad, if you want to sell your shares, I'll find you a buyer. I just enough. People are. I think there's a lot of people who would love to buy OpenAI shares. I don't think you would,
including myself. Including myself.
People who talk with a lot of breathless concern about our compute stuff or whatever that would be thrilled to buy shares. So I think we could sell your shares or anybody else's to some of the people who are making the most noise on Twitter, whatever, about this very quickly. We do plan for revenue to grow steeply. Revenue is growing steeply. We are taking a forward bet that it's going to continue to grow, and that not only will ChatGPT keep growing, but we will be able to become one of the important AI clouds, that our consumer device business will be a significant and important thing, that AI that can automate science will create huge value. So, there are not many times that I want to be a public company, but one of the rare times it's appealing is when those people are writing these ridiculous OpenAI is about to go out of business and, whatever. I would love to tell them they could just short the stock, and I would love to see them get burned on that. But, we carefully plan. We understand where the technology, where the capability is going to go, and how the products we can build around that and the revenue we can generate. We might screw it up. This is the bet that we're making, and we're taking a risk along with that. A certain risk is if we don't have the compute, we will not be able to generate the revenue or make the models at this kind of scale.
Exactly. And
let me just say one thing, Brad, as both a partner and an investor. There is not been a single business plan that I've seen from OpenAI that they're put in and not beaten it. So in some sense, this is the one place where, in terms of their growth and just even the business, it's been unbelievable execution, quite frankly. I mean, obviously, OpenAI, everyone talks about all the success and the usage and what have you. But even, I'd say all up, the business execution has been just pretty unbelievable.
I heard Greg Brockman say on CNBC a couple of weeks ago, right? If we could 10x our compute, we might not have 10x more revenue, but we'd certainly have a lot more revenue.
Simply because of lack of compute power. Things like, it's really wild when I just look at how much we are held back. And in many ways, we have, we've scaled our compute probably 10x over the past year. But if we had 10x more compute, I don't know if we'd have 10x more revenue, but I don't think it'd be that far.
And we heard this from you as well last night, Satya, that you were compute constrained and growth would have been higher even if you had more compute. So help us contextualize, Sam, maybe how compute constrained do you feel today? And when you look at the build out over the course of the next 2 to 3 years, do you think you'll ever get to the point where you're not compute constrained?
We talk about this question of, is there ever enough compute, a lot. I think the answer is the best way to think about this is like energy or something. You can talk about demand for energy at a certain price point, but you can't talk about demand for energy without talking about different demand at different price levels. If the price of compute per unit of intelligence or however you want to think about it, fell by a factor of 100 tomorrow, you would see usage go up by much more than 100. And there'd be a lot of things that people would love to do with that compute that just make no economic sense at the current cost, but there would be new kind of demand. So I think now, on the other hand, as the models get even smarter and you can use these models to cure cancer or discover novel physics or drive a bunch of humanoid robots to construct a space station or whatever crazy thing you want, then maybe there's huge willingness to pay a much higher rate cost per unit of intelligence for a much higher level of intelligence. That we don't know yet, but I would bet there will be. So I think when you talk about capacity, it's like a, cost per unit and, capability per unit. And you have to kind of, without those curves, it's sort of a made up number. It's not a super well specified problem.
Yeah, I mean, I think the one thing that, Sam, you've talked about, which I think is the right way is to think about, is that if intelligence is whatever log of compute, then you try and really make sure you keep getting efficient. And so that means the tokens per dollar per watt and the economic value that the society gets out of it is what we should maximize and reduce the costs. And so that's where, if you sort of where like the Jevons paradox point is that, right, which is you keep reducing it, commoditizing in some sense intelligence so that it becomes the real driver of GDP growth all around.
Unfortunately, it's something closer to log of intelligence equals log of compute, but we may figure out better scaling laws and we may figure out how to beat this yet.
We heard from both Microsoft and Google yesterday. Both said their cloud businesses would have been growing faster if they have more GPUs. I asked Jensen on this pod if there was any chance over the course of the next 5 years we would have a compute glut. And he said it's virtually non-existent chance in the next 2 to 3 years. And I assume you guys would both agree with Jensen that while we can't see out 5, 6, 7 years, certainly over the course of the next 2 to 3 years, for the reasons we just discussed, that it's almost a non-existent chance that you have excess compute.
Well, I mean, I think the cycles of demand and supply in this particular case, you can't really predict, right? I mean, even the point is, what's the secular trend? The secular trend is what Sam said. Because quite frankly,
all right, everyone. So definitely do watch that interview when you have the time. But definitely in terms of compute glut and of course the limitation on supply of compute, 2 to 3 years is the forecast. Jensen Huang, Satya Nadella, Sam Altman, all really kind of guiding in that direction that there is virtually not going to be a compute glut over the next 2 to 3 years. In other words, an excess situation where there is an excess supply of compute and data centers, and Google and Microsoft would be growing faster. The cloud services would be growing faster if they had more access to chips to build these data centers for AI computing. So there you have it. And of course, we can debate all along for the conversations around the valuation of OpenAI and the commitments to spend with the revenues of around 13 to 14 billion. Of course, it's a private company, but nonetheless, we'll leave that for some other day. The markets are indeed open now. So we are sitting at Nvidia down about 2.5%. We got Iron down almost 5% at the open. We got QQQs also down a little bit over 1.5%, with the S&P 500 down over 1% as well. Alerts are firing off. Thank you so much for joining, everybody. Link is going to be down below if you're interested in joining our MoneyVest platform and, of course, our community with real-time trade alerts, members-only videos, portfolio updates. Everything is going to be available. Any questions, email me at admin@moneyvest.com. And as always, have a great Tuesday morning. I'll see you all in the next